Hi everyone! Deciding how many shares you should have in your portfolio to be properly diversified has occupied experts ever since you could have a portfolio really. What does diversification actually mean anyway? What are the benefits and downsides of it? And how many shares should you have in your portfolio to actually achieve it? Well, in this video we'll find out. I'm Anthony, and as always, we're talking money. Okay, let's first of all define our terms. Diversification in this context is a method by which we can reduce the exposure risk of owning a particular share or sector by owning other shares and also owning them in other sectors. Diversification reduces what is called unsystemic risk or specific risk, that is specific to one company or industry. This compares to systemic risk that is associated with the general market as a whole. Index trackers that invest in the whole market still have risk, but the risk is dictated by the aggregate of all those companies together. Individual stocks have risk specific for that company and can crash and burn or rocket because of unique factors affecting that one company, regardless of what is happening to the rest of the market. So if owning one share exposes us to the risk unique to that company, owning two shares divides or shares that risk. This sounds pretty obvious, but something rather interesting happens. It's unlikely that these two shares will move exactly the same. I can't think of any two shares that move up and down exactly together over a significant period of time. So the end result is that any gains are not going to be as great and any losses are not going to be as great than if we just stuck to our one initial share. Now add another one and another share and another one and another one. All these shares will move differently. So with each addition of a new stock, the gains and losses are reduced to the point that the only gains and the only losses we experience mirror that of the general market as a whole. The more we have, the closer we get to having a tracker fund. So there's definitely a balance to be had here. Have too many shares, and you might as well just stick to a low-cost index tracker like the ones offered by Vanguard. Have too few shares and our losses may be too great, or we may be lucky enough and have great gains too. Essentially, there is a balance, and there's a classic risk and reward trade-off. Fewer shares equals higher risk, which equals the possibility of a greater return or a greater loss. So we want to be diversified to minimize specific risk, but not too diversified that we can't get greater returns than the wider market. Fortunately for us, much research has been done on the subject. Perhaps the most succinct is from Frank Riley and Keith Brown in their book Investment Analysis and Portfolio Management. The takeaway conclusion from that is that if you randomly select 12 to 18 stocks, assuming they're roughly spread across the market and not all from, just say from retailers or just from construction, say, you can achieve about 90% of the maximum benefit of full diversification. This is quite remarkable really, given that in the UK the market has about 2,000 stocks in it, and all you need to achieve 90% diversification is about a dozen or so shares. The implication is that you need to buy a further 1,985 stocks to achieve just 10% more diversification, or that of an index tracker. 18 stocks is much easier to handle and keep a track of than having 2,000. The other thing to note is that when you start to get above 20 stocks or shares, and certainly above 30, it becomes very hard to keep a close eye on those stocks. You know that if you are keen on a handful of stocks and follow them closely, you become intimately aware of their price movements, company announcements, maybe even key personnel, possible threats from competitors or regulation, etc. You're more keen to sit up and take notice whenever you see the company mentioned in a newspaper or indeed my favourite Yahoo Finance. More than 20 or 30, and you become more distant from knowing these stocks well. I'm definitely guilty of this myself. The smaller portfolios, like the Talking Money portfolio that we started recently, far exceed those with more shares in them, like the dividend portfolios that I've had and I've added to over the last 20 years or so. The small portfolios are the ones that I keep track of intimately, and I see those shares on a daily basis and get a real feel for them. The larger portfolio that has, say, 38 shares in it, I know I need to trim this back a little bit, but hey hum, I'm only human. To have a look at this in real life then, have a look at the performance of the new Talking Money portfolio with Interactive Investor that we started at the beginning of April. We started it with 7 shares. Actually, I've added an 8th share to this portfolio, and it's up by nearly 12% now. The FTSE All Share Index is only up about 4 or 5% in comparison. The larger portfolio, which as I say has got 38 shares in it, is up by a similar amount, about 5.5%. Still about the same as the index, but it's going to be much harder for this portfolio to see great returns. One's ability to narrow diversification down allows greater returns, but we have to be aware that things can turn quickly, and that's where we put our stop loss limits in to act as a brake on those losses. Imagine them as cams that climbers put in the rock face to prevent them falling too far if they were to lose their footings. While greater diversification may reduce risk to that of an overall tracker or index tracker, it really achieves this by reducing volatility of our portfolio. Volatility is a short-term friend for a day trader, but it's synonymous with risk for long-term investors like me. To make sense of this, take a look at how risky a very volatile asset class like crypto or in particular Bitcoin is. As a long-term investor, we ideally don't want 10% swings in the price over a day. We could hit our stop loss limits in just 2 days. Remember that the longer we're in the market, the longer we have to take advantage of those compounding dividends. Have a look at this graph. I've shown this a few times. Most of the stock market returns come from those reinvested dividends. Finally, a sobering thought as to how difficult it can be to get a diversified portfolio comes in a study entitled The Capitalism Distribution by Eric Crittenden and Cole Wilcox, who studied the whole of the US market known as the Russell 3000 between 1983 and 2006. They illustrated just how difficult this is. The summary of their findings is as follows. 39% of stocks were unprofitable. 18.5% of stocks actually lost 75% of their value. 64% of the stocks underperformed the Russell 3000 as a whole, and only 25% of stocks were responsible for all of the market's gain. So the secret is trying to find those 25% of stocks. To do this randomly, 3/4 of our stock purchases would lose us money. This goes some way to explain why so many people give up investing after they've had their fingers burned. Think of a recent Deliveroo launch in the UK that lost money really from the start. Or in America, those people who got in with GameStop at the wrong price, only to see most of their investment disappear once the tide turned against them. Certainly diversification increases the chances that some of our picks include those winners, and index trackers, although will include losers, will also include all of those stocks that are responsible for all of the stock market gains. So in conclusion, and this is my personal opinion, I think having any more than 20 stocks in a portfolio is probably getting a bit too many, but how to choose those 20 stocks and how to avoid those terrible, horrible losing shares. I guess many of you listening to this channel are either seasoned investors and have loads of experience in this, but I suspect some of you may not have a clue, as I certainly didn't when I first started out. I don't have any kind of system to sell, and to be honest, I wouldn't really trust anybody who did have a system to sell. All I have is just a little bit of experience, good and bad, and that's what I can share with you guys. We can never know for sure what the future holds, and this is particularly true of investing in shares. All we can attempt to do is to increase the likelihood of choosing good shares and limit the chances of choosing dud shares. I personally use Stockopedia as a useful tool, and you can take advantage of an extended free trial if you click on the link in the description below this video. And if you do sign up using the link in the description, I think you get a 10% lifetime discount off their standard charges as well. Some of my other videos also shed some light as to how we may be able to choose those 20 shares or so, and at the same time increase the chances of finding those winning shares whilst trying to avoid the losing ones. More importantly though, if you have a structured approach to picking your stocks in the first place and have a logical method of selling your stocks when they start to falter, then definitely put them in the comments section. I'll be really interested to see how you guys do it as well. Anyway, I'm Anthony, just a private investor with some years of experience of investing in the stock market. I'll only share with you my experience and what I've learned over the years, but I'll catch you in the next video. But until then, check out that link from Stockopedia, and you can sift the whole market using your criteria, see what you think, have a play around with it. As I say, if you click on there, you have a 2-week free trial period anyway. But I'll catch you in the next video. Until then, bye for now.